What a glorious breakdown on the Thursday session, but on Friday, absolutely no follow through. Where were the sellers? Complete crickets. So the key question to ask this week is who will win the battle of the timeframes between the weekly high or low being defended or the daily downtrend continuing? Let's build a game plan that's based on logic to try to answer that question in today's episode of the Weekly Watchlist. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we're dealing with a green-bodied inverted hammer, meaning that the buyers did a decent job of producing a counter-trend rally. The bears stepped up and gave us the daily lower high. And notice that, I'm going to draw this intentionally, we technically on Thursday's close went underneath the opening print and we had ourselves a weekly red-bodied bar that was shaping up. Obviously we can see it's a green-bodied weekly bar, so that means that the close is over the opening print. The reason this is substantial is because Friday, the buyers do a decent job of reclaiming the opening print and simply said the structure on the weekly time frame is not as bearish as it could have possibly been from the Thursday breakdown, right? We'll talk about that lack of follow-through on the daily chart in just a second. Doesn't mean that we're going to ignore this upper wick. Don't get me wrong. Structure is going to go to the bears on this weekly bar, but it's not as bad as it could have possibly been as of Thursday's close. In terms of location on the bar-to-bar count, we do have ourselves a lower high as well as a higher low. It's a very classic inside bar. I would say it's neutral from a location perspective, and if we just add in a little bit more context, obviously with the preceding red momentum back here, you could think of a weekly 3-bar play where if we take out the lows, we are looking for continuation in the downward direction. But before we get aggressive on the downside here, it's worth pointing out we are still dealing with and trying to resolve the prior weekly balance range from back here. The soft lows remain at 432. We've been tracking that level for a couple of weeks now, and if we break from the 3-bar play in the downward direction, we are technically running into the ideal place for a weekly set of higher lows. Remember that if the weekly trend is going to remain up, we have lows, higher lows, higher lows, higher lows. This soft higher low set could be confirmed as firm higher lows, I suppose we could say. With a daily downtrend that has developed here, if we hold on to it, great, we're pulling back from a higher high. We've just found ourselves a weekly higher low, and the trend can continue in the upward direction. The forecasted target would be the equal high, closer to 460. Now, I'm not making that call for this week, next week, the week after that, but that would be how you sequentially think about next targets here on the weekly time frame. If we fail to hold the 432, then of course we will change our tone on the weekly time frame chart. We'll no longer be as optimistic about our weekly uptrend, and we'll search for this level as our next key support around 420, 418. We know that if we throw on the anchored view apps, let's do something like this. These will slowly start to coincide with that area back here. It was the ascending triangle breakout point, right? We've talked about that level for months and months on end. That would be a big monthly retest. The other thing from the anchored view app perspective is that I would not consider the AI Mania anchored view app breakout really resolved yet, right? We've pulled back to it. We closed underneath last week, and this week we closed right on it. So we don't really have firm resolution. You want the inside bar to resolve before you would definitively say that we've either held or broken that anchored view app. Once again, if we hold here, if we push away from this, if we find support around 432 and start to move in the upward direction, that would be a decent looking hold of a weekly anchored view app. Let's go ahead and throw on some Fibonacci's here because these are still top of mind as we move into this week's worth of trade. We talked about them last week. If we do something like this from the all-time high to the October low, from this low up to the top, and from here, the AI Mania low, to the top of the move, we know that we have the 61.8. The more time that we spend above, the greater the likelihood of a 100% retracement. We've got the 38.2 from here to here. So ideal bull flag consolidation remains above that level. And the 61.8 here is what we want to defend to avoid a full retracement to that weekly, or I should say monthly, 420 retest, 418 retest, the top of this breakout from the AI Mania. So once again, I know we're kind of splitting hairs here. 430, 432, that's the key weekly level that needs to hold if the buyers are going to remain in control from the higher time frame perspective. Now, it's worth conceding there's certainly this upper wick that is rejecting the top of the prior balance that we've been talking about. We've talked a lot about the support portion. Let's talk about the resistance portion. The upper wick there does not strike me as a warm and fuzzy feeling. There's nothing about the structure, the inverted hammer, that would suggest we're ready to just turn here on the weekly time frame and make the equal high. And also, right, we could start to see this on the daily chart as well. Even if we do rally a little bit further but continue to reject 445, that certainly brings into question a weekly head and shoulders for a stronger reversal to the weekly 420. So we're open to that idea. We just don't have a definitive breakdown yet of the 432 zone. And because the prevailing winds are in the upward direction, we're going to try to assume that there's an attempt to hold on to that level here. Let's take a look at the volume profile and see if this is confirming or denying any of the things that we've just been discussing here. I'm going to zoom into it this way this week so we can see with a little bit more detail where those volume nodes are. I would concede, once again, the bears did a great job of setting the daily lower high off of a weekly high volume node. That would be a bearish indication. This is 430 right there, right? I'm not going to argue that this high volume node is nearly as strong as this one or this one down here, but it is technically there before falling all the way through the low volume void and making that rotation towards the 418, 420 monthly higher low area that we've been discussing, the breakout point from back down over here. So I think everything that we can glean from the weekly time frame chart is that 432 is an incredibly important area if the most optimistic uptrend here is going to remain intact on the higher time frame. Let's take a look at the daily and see how that could resolve. Let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right hand corner. If we're contained by the upper bound, the number is 446.74. That would be a very nuanced higher high above the Thursday open where the breakdown came from with NVIDIA earnings and just rejecting that key level we'll discuss in just a moment. In terms of the lower bound, that's going to be at 433.20. If we're contained there, that would be an equal low on par with 2 Fridays ago. So overall expected move does strike me as being slightly more neutral. I would be very skeptical of thinking that we could breach 445 in an easy way. Why is that? Well, of course, we are now in a daily downtrend with highs. Lower high has been set. Remember that we had an hourly counter trend move which cemented that daily lower high. This was never really an hourly uptrend, no hourly uptrend here. This was it. So we've got the lower high and we've also got the lower low. I mean, from here to here, you've got a lower low. Remember that these were soft lows, no hourly downtrend in this segment. So, okay, we're all on the same page. Daily downtrend is now established. And why would we be so skeptical of 445, right? If we do something like this, we remember it as prior resistance, gap level, no hold there. We remember it as the bottom of overhead supply, daily 50 SMA, resistance trend line. If you come in and do something that looks like this, it goes on and on and on. I've got a couple more that I can share with you. You just tell me when to stop. We can come from here up to the high 61.8 Fibonacci, right? It's a great retest and rejection of that level right there. And we can take it one step further. I promise this is the last one. If we throw on the alternate sets, right, the channel that we've been watching for quite some time, there's the start, there's anchor 1, touch 2. We looked for support there as it didn't hold. Break, retest, lower high underneath the lower bound of the trend channel. So, okay, I promise that was the last one. Just confluence of resistance big time at that level 445. So the reason I bring that up is because although we do have a failure from the sellers on the Friday session, I'm not convinced that the upper bound of this week's expected move is going to, quote, easily be achieved, right? There's a lot of confluence of resistance here at that 445. Now that we honestly have the lower high in place at that level, you can add that in as a data point, right? So what do we see here in terms of pattern? Well, as we talked about on the weekly time frame chart, if this is going to be a head and shoulders, you need to take out the lows at 432. Lo and behold, that's the weekly higher low set that we just drilled home, right? 432 is the number that must fail if you get a daily head and shoulders to kick off a weekly move towards that 420 level. What else can we see here from a pattern perspective? Well, if this is going to turn into a higher low double bottom, it's definitely on the table as being a possible catalyst or the possible pattern that cements your weekly higher low holding 432, right? If this double bottom does play out, great, we've held the weekly higher low here, but what do we need on the daily time frame? You need a breach of 445, higher low retest above, and then the equal high is back on the table that we discussed around 460. And as we just walked through in terms of resistance, 445 is not going to be an easy level for all of the magnitudes and all of the reasons that we just stacked up. So we really need that break and retest confirming that 445 is now going to act as support if you want to be more optimistic about the weekly higher low holding there. Now, we do have the daily hammer in place, and we'll talk about this on the hourly chart in just a second, but we swept the low of Thursday's session, no follow through from the sellers. And where did we close? Not only over the weekly open, but over Friday's open. There was no rejection there towards the high of day, right? We honestly closed fairly strong on the Friday session, also recapturing a key level in here around 439.25. So if the weekly high or low is going to be on the table, this hammer needs to resolve. We need to see a move over the hammer high, break 445, higher low here, and then we're off to the races. Weekly higher low is in place. Daily downtrend is going to certainly come to an end sooner rather than later. For the bears to really build something more so with momentum on the weekly time frame chart, as we pointed out, you need the breach of 432. Let's take a look at this study set. We haven't looked at it in quite a while, but the anchored view apps from the bottom, October down here, anchored then to all of the major pivot points, all the key inflections out of the market. Notice that we're still above a bulk of the ones from underneath us. This is the AI Mania breakout anchored view app set from back here. The extremes, right, of the April balance. Remember that this was like the godforsaken range as we dubbed it back then. Those anchored view apps are coming into play. If the market tries to hold that, is this a logical place where the weekly time frame chart could make a stand? Is it a logical place where buyers who got involved from this area and ever since then would try to defend their positions? Absolutely on the pullback. So this 432 really has a lot going for it, and the only way that we're going to be more optimistic about it holding is if we get the daily double bottom over 445. Let's take a look at the hourly time frame chart. I want to walk you through why Friday's failure was so substantial, right? We do rally first on the Friday session, so fantastic. We're taking out some of the shorts with terrible location from Thursday's close and even in the overnight session, and then we start to break down. So everything's making sense. Shorts get better trade location, shorts who chased get swept out, and the buyers get stopped out as well as we break down underneath Thursday's low. So fantastic. Everything should be going for the bears at that point in time. Why was it that we see a substantial reversal? Now, I get it. Of course, there were the comments from Jerome Powell. It was Jackson Hole. There was a lot of volatility there. I totally understand. But if the sellers were going to make a more substantial move and get some follow through from the Thursday breakdown, you would have thought that there was a point of no return underneath Thursday's low, or even just rejecting the opening print here for a lower high into the afternoon and then closing weak underneath Thursday's lows. It simply was not the case, and we honestly recapture almost, not quite all of it, but about 50%, almost there, right, of the Thursday breakdown. We closed slightly underneath, scratching at it into the afternoon of Friday. So it makes me think to myself, like, sellers, like, what, like, you had the perfect setup. You got the move higher, better trade location, right? Short into that weakness, make the lower low, and then run away with it. So the sellers lacking performance on Friday session leaves me in a position to sort of say, I would imagine that the market tends to be a bit more neutral in this area right here. I wouldn't honestly prescribe more of a bearish edge if we're over 439.25, and I would look for neutrality. It certainly looks like we could come in for a retest of 442.65. We wouldn't be bullish on that, of course, right? This is really not a bullish indication. The bullish indication for the double bottom, as we just pointed out, is breaching and reclaiming 445. So nothing about that changes. I don't want to come off and sound like I'm just this massive bull now and we're flip-flopping back and forth, but I would have to maintain more of a maybe neutral, slightly bearish edge if we're over 439.25 but under 442.65. If we clear 442.65 and get a higher low intraday, it's game on to test 445. Like, at that point, you've reclaimed too much of the Thursday breakdown. I think you're going to get a bit of a squeeze into the high of that day's session. So that's the upside there. The downside, of course, it's quite simple, right? If you think of this, instead of looking at it as hourly double bottom like this, what about hourly head and shoulders, right? And patterns are just a way to visualize different trend reversals, where higher lows, where lower highs are. But what that would require is the right shoulder panning out, aka getting underneath 439.25. I would trade lower highs underneath that into our quote neckline here at 436.50, and then lo and behold, you get your weekly level at 432. So that's really the roadmap that I would follow here into the early stages of this upcoming week. Once again, being more so neutral after the clear, now that we've walked through it, failure of the sellers on Friday's early morning session. If we're above 439.25, more bullish on higher lows to get to 445 over 442.65, and bears regain control a little bit more definitively on lower highs below 439.25, trade for downside outcomes 436.50, and then 432 is your weekly area of support. Real quick, what do we see for confluence with the anchored view apps, and then we'll move through some supporting evidence. I think that this really just builds the case. Once again, anybody who's short in the hole, this is the view app section that needs to break. You're getting massive confluence with the anchored view apps around 439.25. This is coming from the high of the entire move. This is the low of the entire move. This is when the breakdown from the overhead supply began. And this is the anchored view app from Thursday's session, right? This is another key component as to why sellers failed on the Friday session. There's the anchored view app. If sellers are going to remain in control, you want shorts with even the best possible trade location from the Thursday breakdown to remain green. And obviously a recapture of that anchored view app, it's putting them on edge a little bit. So Neutral here, bullish for the retest of 445, more definitively bullish on the daily chart, higher lows over 445. This slip here, yes, we're trading for downside outcomes, daily downtrend remains in place, and everything else falls from there. Supporting evidence exhibit A, market internals. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Net volume flows on the week are negative 138 million. Substantial reads are negative or positive 500 million or beyond. Not even close. On the Thursday breakdown, we get close to negative 300 million, but with the magnitude of a day like that, you would have expected a breach and close well underneath negative 300 million. Sort of raises some questions there about the strength of the sellers, and obviously Friday speaks for itself, neutral to up on Friday's session. On Thursday, I get it, we opened on a gap up in the first place, but why were we not aggressively in trend lower zone out of the internals there? Friday once again speaks for itself, being a little bit more neutral and maybe even a bit optimistic on the bull side, not really spending too much time underneath that zero line. The cumulative builds on the tick, it was substantial in the downward direction on the Thursday session, but it follows up a positive read from Wednesday, which got us to that location in the first place. Friday actually closes out positive as well. Now, there's nothing to write home about on Friday's internals. It's not like these are overly bullish. We're not making the argument that we're just going to go and make these equal highs, higher highs, new all-time highs in the S&P. But I think that the internals here speak to the neutrality I was expressing on the SPY in between those two key levels. Market profile is always exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's start simple and then get a little bit more advanced on this one today. For the most part, what's going on with the value area and point of control? So there's Wednesday, there's Thursday. Obviously, value shifts lower, as does the point of control. Thursday into Friday, there's value on Friday. There's your point of control shift in the downward direction. So great. There is technically some progress being made in the downward direction. However, I would point out that on Friday, again, value is inside of, for the most part, the entirety of the Thursday range. If you just extrapolate out the low of Thursday, maybe a little bit of value is underneath, but for the most part, we're contained within. Certainly the point of control is within as well. So that's first and foremost a little bit of a head scratcher, and once again speaks to the failure of the sellers. But wait, it gets better than that, right? If the sellers, technically, from the end of day on Thursday, in this spike, we're going to be caught off sides, we would need to open above the spike. And that's exactly where we opened on the Friday session. So sellers who were short in the hole from Thursday should have squeezed out, and they did. We can see that B period makes a high up here. And then when we go back down through the opening print, make a new low of day, that's where, now underneath the Thursday session, the sellers should have ran away with it and produced something like this into the afternoon if they were going to see follow through. So based on the spike here and opening above the top of the spike, which in the downward direction would be a bullish indication negating all of the sellers who committed volume down here, we did see the proper sequence. There was a move in the upward direction. These shorts got burnt. New shorts step in. We get follow through. And also we reject here, failing to get into the single prints. So if the market were more bullish, we probably would have moved into the single prints, done something like this to close it. It didn't happen. So everything here off of B period's high made sense into the low of day for the sellers to remain strong. It's simply that into the afternoon session, they did not. It was very short-lived at the lows. You can see C and D period back to back, and then all of the price acceptance for the remainder of the day, for the most part, is back within Thursday's range. So I think that the market profile here does a great job of speaking to inventory and how the trade was at first unfolding properly. And now, when we look at it through the lens of the story of the day, there really wasn't the proper follow-through underneath Thursday's low to speak to stronger sellers getting active in this market. You can just see that, even if you want to use the simple early stage of the market profile analysis, with the value area primarily being contained within Thursday's range. So no matter how you slice the cake there, Friday does seem like a failure from the sellers in my estimation. We do have a lack of material excess at the lows and highs, and in my eyes, that would kick off the next move from our market. If we take out Friday's high, that would be taking out the hammer high on the SPY daily structural chart, right? We would look for a retracement through the thin structure. 4450 becomes a target, and then Thursday's high of day, which is around 4470 out of the ES. As we know on the SPY, it's 445. And to the downside, if we take out the lows, we're walking down some targets. What do we have on the market profile? I'll give you the futures levels. I know a lot of folks have been asking about the futures levels. It would be your prior Friday low at 4350. Jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that the XLK, the heaviest weight risk on sector, the tech sector, led the pack here this week, up a whopping 1.75%. It was followed by real estate, really lightweight sector, but then we see consumer discretionary and communications. At the bottom of the barrel, it's the energy sector, down a whopping 1.77%, followed by consumer staples, materials, and then even financials down towards the bottom of the barrel here, but mostly flat, only down about 0.12% there. So if we think about the sectors that have led the counter trend rally in the upward direction here, it was primarily driven by tech, which is a heavier weight risk on sector. And as we talked about in prior episodes, if that were the case, then we might want to be a little bit more open to the possibility of that weekly higher low holding at, once again, here on the SPY, 432. So this is making sense from a posture perspective. Let's take a look at the structural charts and see what really needs to take place, because I think that the lower high that was set on Thursday's sessions across the board is the key watch. Obviously on your XLK, because of NVIDIA being a heavyweight component in this sector, it's going to be a higher gap up. But if we can get over 170.25, that starts to make this look much more so like an inverted head and shoulders. Don't get me wrong, we're not bullish out of the gates there. You need a higher low, then we're trading for an outcome into 175.70 for then the possibility of a lower high from that perspective. So it's not rainbows and butterflies, but you could certainly build the case here how if this pattern does materialize like this, it's probably upward pressure into the early stages of this week. So watching 170.25 quite closely and higher lows at this point, now that we've got this close back inside of Thursday's range, wants to stay above 167.90 on your XLK. Also prior support from the right portion of the inverted head and shoulders. If we get underneath it, starts to look much more so like an H pattern breaking the lows, sets up more pain for our broad market. The weekly higher low would not hold, in my eyes, in that case, under 163.25. Heaviest weight sector, worth spending some time on. Real estate, really lightweight sector, midpoint of this prior range, downward pressure, upward pressure, upward pressure. Lightweight sector, not going to make or break anything. XLY, what's going on with consumer discretionary? Certainly worth talking about over here. And once again, the primary watch on a lot of these names will be, can this turn into a double bottom? Or if it doesn't, it's looking much more so like bear flag consolidation. Taking out the lows sets up more pain for our market. So watching very closely this number right here, 167.25 out of the XLY. And just like the XLK, it's not rainbows and butterflies. There's still the opportunity for a lower high to be produced from this perspective. Here on the back test of 170.25, but it's certainly interweek upward pressure for the broad market. So that's the upside. Downside is, once again, if we just remain neutral consolidating in here, call a spade, it's a bear flag, right? Next up, XLC communications, also a heavier weight risk on style sector. It's certainly more, I would say it's in the midpoint of weighting for our S&P, but nonetheless, look at how there's not as much of a green bodied hammer there on the Friday session. It moves lower as well and actually makes a new lower low underneath the low from here. So this has a lot more work to do. Don't get me wrong, it's still all eyes on 66.75 if it wants to produce a double bottom. It's got to do something like that, but with more distance to travel, still underneath the 50 SMA, I think that this one has more of an opportunity to remain weak out of the XLC. To me, this is looking much more so like a rounded sort of top. You could make the argument for head and shoulders like this. We're underneath the neckline. You could call it whatever type of pattern you want, but feeling much more so like distribution up here with the lack of proximity to that Thursday high, basically. Utilities still look incredibly weak. So from a posturing perspective, the weaker this stays, remembering that it's D for defensive sector, I mean, it's honestly not that bad for the market, right? If it does break down and the XLK breaks down, then great, we're back into that full-blown correlation mode in the downward direction. But if the XLK is rallying, picking up the slack, not concerned with utilities in this little range down here. Next up, industrials. This looks a little bit weaker to me. Noting the bear flag consolidation has a long ways to go until it actually comes into the retest of that overhead supply at 108.15. So still looking for a lower high on that one for a little bit more downside out of industrials. We'll change our tone if we get a higher low above, but nothing about this would be overly optimistic about that yet. Still looking more so like a bear flag there. Energy, what's going on with energy? So D for defensive, it was sort of leading the way back over here, but it fell off, right? Obviously, it was the laggard on the week. So if you want to talk about posture, I mean, it's not even close to a downtrend, that's for sure. So as long as this remains neutral, it wouldn't really be much of a drag for our broad market. Next up, consumer staples. What's going on with staples? More similar comments as to what we just discussed out of utilities. This is even more so D for defensive. I would say utilities and then consumer staples are the lineup of the two most defensive sectors. And seeing this really weak on the lows, once again, if the XLK is picking up the slack, this is not the end of the world. I wouldn't be a new money short down here. We've already talked about 100% retracement, terrible trade location for new shorts. If anything, a rebound here would help boost some of the gains out of the S&P if the XLK is rallying as well, right? You're starting to work your way back into full-blown correlation to the upside off of this as an oversold reading after the 100% retracement. Same thing would apply to the utility sector if, again, the XLK is also rallying. Next up, XLB for materials, lightweight sector, neutral, bear flag. We'll kind of leave it off at that. Still an opportunity for a lower high underneath 82. Financials really have to get into gear here. Obviously, with rates and Jackson Hole, I could understand some anticipation there, but it's got to get in gear. It's got to get up and over 34.20 if we're going to be more constructive on the broad market, being a critical component, financials that is, of the risk on cohort. I mean, it doesn't give me a warm and fuzzy feeling to just see it sitting sideways, consolidating on this key weekly level that we need to hold for a weekly higher low, right? If we fail that, that spells pain. That spells pain for the S&P in my eyes underneath 3365. I would imagine that people are probably making bets on credit events and, debt issues if financial sector as a whole breaks down underneath that 3365. We'll talk about that as we get to the fundamental rundown. Next up, we've got the XLV. What's going on with healthcare? Second heaviest weighted sector, but D for defensive as we know. Lower high consolidation in this range. Again, XLK, if it's picking up the slack, it's not an issue. If this does break down and the XLK is also moving lower, you're going to get full-blown correlation to the downside. Being defensive, but also being the second heaviest weighted sector, it's very difficult for the market to have a green day if those, again, top two slots are both moving in the downward direction. Key inflection points quite obvious at 132.65, both key moving averages. I would be a bit skeptical of this one, honestly, with the first reaction off of those moving averages not really producing a move up for the equal highs, right? If this was going to remain a range, you want to see ping pong back and forth all the way up to the top, not this lower high being set from here to here. So this does strike me as a bit of a risk. I would say that healthcare is going to be a watch around 132.65. Here's the sector ratio grid to visualize relative strength and weakness. If you're not familiar with this screen, here's a video tutorial in the top right-hand corner on how to set this one up. For the most part, we're still in a neutral risk category. I would not say that we have full-blown risk off, but risk on isn't looking fantastic. I mean, look at the XLK underneath a now descending 50 SMA. Certainly an opportunity there for a lower high, so that's not really a warm and fuzzy feeling. I'll give credit where credit is due. It's making a counter trend move, but it's got to get more firmly above that 50 SMA if we want to have more confidence in the daily double bottom playing out as a weekly higher low on the S&P, right? XLV is kind of going sideways in here. It's above a neutral now 50 SMA, so it's not full-blown risk off. Financials struggling, as we just pointed out, around that weekly level that needs to hold. XLY also struggling. So credit where credit is due out of the XLK, but other than that, we have a pretty lackluster risk on cohort. XLC sort of ties into that, and you can see that we're going sideways here with a possible daily lower high, threatening an equal low breakdown. So neutral on the risk on side of things, but risk off isn't, perking up in any major degree. You can see XLP still suppressed underneath a downward sloping 50 SMA. Same thing with the XLU. Energy, it's certainly going sideways up here, but again, this is much less defensive and just more so a lightweight sector. Same thing with real estate. It's moving in the downward direction, but it's a lightweight sector, much more to do with the wealth effect. It doesn't strike me that we have this big push for a risk off style move in the market as that big downdraft unfolded on the Thursday session. Even look at these ratios. So we've got the XLK Tech versus the XLU Utilities. Classic, the most bullish and the most defensive, right? Or I should say the most risk on and the most defensive. It's just sideways. The main point that we made in the Wednesday update was that these charts, and we even talked about this last Sunday, it's too early to call the full-blown rotation to risk off. We just do not have that when you look at a ratio pairing like this. And the same thing could be said about the XLY over the XLP. A little bit more of a struggle here with the lower high set that's building out. It's not nearly as neutral. To give a small edge to the bears with the lower high, threatening the move through and now pretty much flattened out 50 SMA, but it's not aggressively breaking down, right? And even at that, we know that we can't afford a higher low pullback on something like a weekly perspective for lows, higher lows, higher lows, and still be kind of okay. So the more I look at these sectors not flipping to full-blown risk off, the more I'm sort of inclined to say, all right, with the lack of follow-through on Friday, maybe this does turn into a double bottom, and maybe it is a very short-lived daily downtrend that was produced. I mean, we were able to harbor some gains on the Thursday session, but if it reverses from here, we've got to play the charts in front of us, and none of them would be overly suggestive of just yet seeing more continuation in the downward direction. Our good friend the dollar just made a brand new higher high, and after experiencing a look below and fail with multiple confirmed instances of higher lows here, the target has to be the top end of the range at 105.65. And I know we were just a little bit more bullish on the sector lineup, but this dollar relationship would certainly suggest suggest that there could be some more downside pain for the broad market if we make the full rotation up to 105.65. So you've got to kind of balance these data points. And if you're trading the S&P, just trade the S&P. If we're over the neckline of the double bottom, great, we'll be more bullish. But just as some context clues, keep this one in the back of your mind. What's the gold contract have to say in terms of, agreeing or disagreeing with the analysis? This sometimes kind of happens in here. Let's go ES and then back to the GC, and our levels should be adjusted. There we go. Some funny thinkorswim quirks. But anyways, break to a lower low from here to here, and now the possibility on a retest for a lower high. And if that does roll over, if we reject 1950s, that would confirm that the dollar can likely go higher towards the top of the range, thus putting downward pressure on equities here. If this does make a rotation into the range, then okay. Now we've got to start to think, could this turn into exactly like what the dollar has done and see a look below and fail? It's certainly not off the table, and that would speak to more bullish odds for equities down below. So those are the two situations, but as of right now, it certainly does look like the dollar could make a move in the upward direction or continue towards the top of its range. Let's take a look at the TNX 10-year interest rates. Let's talk about it from a technical perspective. We'll talk fundamentals when we get to the tracker tool, but nonetheless, in an uptrend, right? This was a mild counter trend pullback in the context of an existing uptrend. There's no reason to believe that this cannot make a new higher high. Not up to studies, but who knows, maybe like 4.5 or something out of the 10-year wouldn't really be that far of a stretch of the imagination, considering, again, the overall uptrend that has built. And we also know that we could zoom this thing way out. Let's go to like a max time frame chart on a weekly here. I'll just show you that there's a big paradigm shift. We talked about this in last week's episode. We'll talk about it again, but we broke the major resistance multi-decade trend line. We produced a higher low, and now we're getting this rounded bottom on the weekly, setting up the move through the equal high. It's totally reasonable to think that rates could continue higher from a technical perspective and also a fundamental perspective, right? We can look at the inverted ZT, then we'll talk about the Fed tracker tool in just a second, but this just broke to a brand new closing high. Right, brand new higher high. What would that suggest based on our analysis over the past couple of weeks? It's certainly reasonable that the Fed might raise rates one more time, and the Fed tracker tool is actually confirming that. Let's take a look. So here's a snapshot of the meeting probabilities prior to Jackson Hole kicking off on Friday, and you can clearly see that we're just higher for longer, hovering at that 525 to 550 basis points. Jackson Hole kicks off, Jerome Powell gets on the mic, and we learn absolutely nothing new about his stance on monetary policy. We're still higher for longer, we're still data dependent, there's no comment from a government interest perspective. There's no comment on a credit downgrade perspective. And at the end of the speech, Jerome Powell quite literally says, as is often the case, we are navigating by the stars under a cloudy sky, meaning that we're basically flying blind here. We've got no idea how long the lag impacts are going to take to fully materialize. We don't know how bad it's going to get in the labor market. We don't have any idea about anything, basically. And then what does the market do? Well, if we take a look at the probabilities tab now, you can certainly see how we've bumped out one more rate hike here to 550 to 575 as the terminal rate. From there, we're continuing to stay higher for longer. First cut technically coming in the first month of the new year, 2024. And then this was the forecast prior to the Jackson Hole speech, right? And then the first cut from that level would be in June of 2024. So the higher for longer narrative is still very much so alive. And I think that the market is kind of okay with that. I would imagine it's okay with that because if we look at the calendar here, it's a loaded week. We're going to get a lot of data here. It's probably going to be volatile as the market tries to do Jerome Powell's job of saying, okay, if JOLTS comes in this way, we're going to react this way, rates will do this, X, Y, Z, right? I'll just give you my brief forecast. If JOLTS remains on par with expectations, nothing burger for the market. If ADP remains on par with expectations, nothing burger for the market. GDP is where we need to watch out. If this comes in hotter than the expectations, very likely that another rate hike is around the corner. We'll talk about the Atlanta Fed's expectations in just a second. Core PCE, 0.2. That's the expectation. If this misses, you better believe that those rate hike probabilities, if we look back at the tracker tool, these will increase from about a 46.7 to 44.5 to something much more definitive, likely over 50% in the November timeframe of this year. Back over to the calendar, right? If we get unemployment claims that remain stable, nothing burger for the market. We know that the labor markets remain fairly resilient. We'll get the unemployment rate on Friday as well, and if it stays at 3.5, you better believe that the odds of another rate hike coming out are going to increase. That would be my expectation there, just sort of forecasting that, okay, we're resilient enough where if growth comes in better than the expectations and there's likely going to be some sort of wave of price increases because of that, Powell's probably going to drop the hammer and say, that's it. I said higher for longer. I told you that we don't know, we don't have any clue where the lag impacts are going to come in, but higher for longer, right? Let's go with another rate hike. And that to me is the expectation for this week based on some of the fundamental data. Here is the Bank of Atlanta's expectations, right? And it's not so much the number, right? Let's not get hung up on 6%, quarterly GDP. The point is the overall directional vector, which is substantially higher. I mean, look at these big moves in there, right? If that's any sort of a forecast and growth comes in better than expectations, again, you have to imagine that implies financial conditions are loosening, like the economy's improving, which to some degree, Jerome Powell wants to be restrictive for the economy. So one more rate hike based on everything I can see kind of makes sense and is on par with what Powell has said if he's truly going to remain data dependent. Here are just a couple of more fundamental charts. This is total non-farm payroll on a year-over-year change plotted, and you can see prior to the sickness, this is about status quo here at 0.01, right? And you can see that we're drifting lower towards what was prior status quo. So if we're talking about a resilient economy, a labor market that remains strong, sure, if growth slows down in new hires, it doesn't look good, but are we approaching dramatically like recessionary type levels? Absolutely not, as long as we're kind of on par with that 0.01 here on the year over year. It's not that precise. The visual is much more so important rather than the figure over here. We could look at something else like, let's have a look here at the participation rate. If you want to talk about labor supply, right? This has room to grow, basically. It has room to grow into the pre-sickness trend, which would be healthy for reducing wage price spiral odds, right? If there's more people entering the workforce, technically there's more supply of workers, prices can come down from an hourly earnings perspective. Now, I know nobody wants to hear that from an inflation perspective. Oh, we want higher wages. Well, if there's more labor supply, it's not going to work that way. So again, this would be a deflationary thing, not an inflationary thing, if labor force participation actually upticks when the report comes out on Thursday or Friday. I can't remember which day it was going to be there. Let's take a look at the unemployment rate as well, right? Because we know historically that this is very difficult to put back in the bag once the cat is out, right? Once we break that rolling 12-month moving average, basically a rolling yearly average, it's very difficult. 3.5 keeps us underneath or at the 12 SMA. So no issues there from a large spiral out of control. If we break it, we'll be concerned. Don't get me wrong. We will change our tone if we have to, but nothing about this chart yet would suggest an imminent threat. And we can also look at financial conditions. This speaks to the GDP conversation we were having just a moment ago. This is the opposite of what Powell wants, right? He wants fairly restrictive rates, fairly restrictive monetary policy, and this moving lower would be an indication that financial conditions are loosening. He will win the fight of higher for longer if inflation does continue to come down. That would inadvertently raise real rates in the upward direction without him having to lift a finger. So keep that in mind if this does start to move in the upward direction and he hasn't raised rates. It would mean that inflation is actually coming down, and that would be proof of the fact that what he's done has ultimately worked. So that would be sort of a twisted interpretation of national financial conditions, but one that is certainly relevant. What about the market's appetite for risk as this breakdown has taken place? The TLT ratio to the S&P has gone sideways. I will concede that it's basing out a little bit here. However, it's still underneath a downward sloping resistance trendline. So it does not look to me like a full-blown flight to safety trade is unfolding. Even if we zoom in on the chart up above and think about this from a technical perspective, right, is it not reasonable that in the face of a very aggressive downtrend here, we could see a counter trend reaction, which in theory would make the ratio move higher? Yeah, it's totally reasonable. So once again, not a full-blown flight to safety unfolding here in the TLT ratio. If that relationship is broken, we know that we can look at some shorter dated bonds in relationship to one another. And if we take a look at this, we're still elevated out here, which would speak to some uncertainty about the long-term confidence, right? And what I would want to see, if the market does pan out as a double bottom down here in equities, I want to see lower lows out of these relationships, lower lows underneath these areas right here. This needs to break down. This needs to break down. This is the closest on the longer side of the curve, IEF versus our TLT. We could take a look at credit spreads as well and see what's going on with this. It is making a move in the right direction. We would say that credit spreads here are tightening back up as we roll over and move downward here. And that would speak to, okay, a decent risk appetite returning to the market and not a full-blown, again, flight to safety, government-backed, you don't want to say ever guaranteed, but, quote, risk-free return, right, versus corporate grade stuff. So this does strike me as more of a bullish look as this rolls over here after making a higher high. Now it's made a lower low. That is ideally what you want to see for a trend reversal, right? Let's take a look at the HYG in isolation. And what is this telling us? This is actually a little bit of a bullish look in my estimation. If we just zoom in a little bit on this, the main point I want to bring is that the HYG held a higher low over this as like a very sloppy but there inverted head and shoulders neckline, right? Whereas the S&P, it did move a little bit lower and it didn't make as clean of a higher low. A higher low is still technically there, but it's not at key structure. So the fact that the HYG held here does strike me as a bullish relationship, and it would speak to possibly looking at this a bit more confidently for the double bottom situation to unfold. So I think overall risk appetite, it didn't really deteriorate through this breakdown on the Thursday session. Take a look at Bitcoin just to see what's going on with the digital gold. Anything over here? Nothing, right? It was another flat week. So we had the big news that I was going to say Starlink, but once again, SpaceX dumped, call it a fundamental catalyst, but we were just breaking down from this overhead range. We've caught ourselves at support. We didn't make a lower low. It does look like bearish consolidation. Please don't misunderstand me here. But it didn't continue to break down. So it's like we've seen the worst of it almost on this snap to the downside. Now we're preparing like, okay, if this comes here, we see that the risk appetite continues to remain strong for the market. That double bottom situation is looking a little bit more attractive. Now, if these charts don't trigger, if the short-dated bonds, for example, make new higher highs, if the TLT ratio breaks the resistance trend line, great, we'll look for follow-through out of the head and shoulders pattern. But so far, none of those threats have materialized. What about the market breadth? This is where we really take a step back and say, all right, let's not forget that we're still in a daily downtrend here with the possibility of remaining neutral to bearish early on in the week for the S&P. New highs versus lows remains underneath the zero line. That is not a warm and fuzzy feeling inside, regardless of what risk appetite really looks like, right? So this is neutralizing our analysis from being a little bit more bullish on the double bottom situation to reeling it back in a bit and saying, you know what? It's not all rainbows and butterflies just yet. This is the SPX A200, our weekly time frame chart here. Stocks in the S&P over the 200 SMA. It's right at the 50% mark. That's not really what we wanted to see. We want to see a turn. We want to see a reversal off of the 50% mark, meaning that a majority of companies in the S&P are holding the daily 200 SMAs, right? Certainly not the case as we just continue to drift to the downside. And here's the most concerning of them all, SPX A50R. This is now a daily time frame chart. Even as this counter trend rally has unfolded, you can see actually that no more stocks like this counter trend rally unfolded. Stocks did not reclaim, broadly speaking, in the S&P, their daily 50 SMAs on the counter trend rally. If anything, more stocks lost their daily 50 SMA, right? That would not speak well for a big recovery effort out of the market. Really, if you're going to see that double bottom pan out, you've got to get this thing back up and over your 50% mark. If we just get a rally for a lower high here, I'd still be very skeptical about the long side in equities and the double bottom panning out. You need the stars to sort of align here from a breadth perspective to be a bit more constructive in your S&P. Let's take a look at the RSP equal weight S&P, and what you'll notice over here is the breakdown wasn't really as aggressive on Thursday, but we're also not getting this big failure. Like, we didn't sweep a major low back here, and if anything, this is looking more so like a bear flag, threatening the breakdown underneath 145.75. To be more bullish, you would want this up and over 150, confirming sort of your look for the double bottom on the S&P alone. So you can see how there's a bit of a discrepancy there, right? If I zoom in on this, this is likely to break the neckline much sooner than this is to actually break that, recapture with a higher low. This, in proximity, is much closer to price than this is way overhead, right? That would be your equivalent, the Thursday high, basically, right? So a little bit of work to do out of the equal weight. Let's take a look at the Dow and see if there's any divergences from that perspective. I already looked and the answer is no, right? We're drifting lower, confirming the sell, no big deal out of Dow. Market volatility honestly puts us right back on the bull side here. Looking at the VIX, not a big move higher on the Thursday session when the market's pulling back, and a move lower to undo everything from the Thursday session on Friday. So we're still above 15, but what do we know acts as a precursor to the VIX? It's the volatility of the volatility index, and this is aggressively breaking down from a very short-lived stay over the 103 level. So if anything, this would forecast that the VIX is very likely to fall underneath 15. And as we know, when volatility is suppressed, it's usually more comfortable for the market to make a move in the upward direction, or at least this would speak to people fairly confident about the posture of the market as of right now. And for all the purists, we know that we can take a look at VIX futures, and this is your small uptick on the sort of relationship where we gauge backwardation or contango. I mean, nothing at all aggressive on the Thursday breakdown, not even close to what we experienced back here in earlier stages of like last month, for example. So nothing about this is overly concerning about a long drawn out style sell where we're reaching closer to backwardation. Now, this can change in the blink of an eye. Volatility can always do that. But so far, with the evidence in hand, it doesn't seem as though folks are really concerned with what took place on Thursday. And it's really looking more so like a flash in the pan. We got a bit of a daily lower high. It was a key level and fantastic that it worked out. But I mean, broadly speaking, volatility is not elevated here. The only thing that's elevated is the one-day VIX with a really interesting bar on the Friday session. We'll report back to you when and if this support trend line breaks. We'll draw some conclusions, and I'll let you know what I'm thinking about that one. QQQ weekly time frame chart. If you love Aerosmith, put your hand up because this is the same old song and dance. There's really not much more to update on in terms of psychology out of the QQQ versus your SPY. So we'll move a little bit faster through the Qs here today. Inverted hammer, green body, same concept with the lower low underneath the open on the Thursday breakdown. We do have, this is slightly different, a higher low and a higher high. It's not enough to really negate this as a prior range. The upper wick rejects the top, and we did support and produce a higher low above the bottom of the prior soft lows. The key level to be thinking about is roughly 360, 358 on the weekly time frame chart. That would be your neckline of this as a weekly head and shoulders, 358. Breakdown from that, and you're walking down about $10 increments. The reason the $10 increments make sense is because of all of the same reasons we discussed on the S&P, coming in with the fib from all-time high to the October low, 61.8, 350 roughly. If we come in from here up to here, lo and behold, your 38.2 is confluence. AI Mania breakout, which starts here up to the high, it's your 61.8, right? I know I was a little bit off, but I was a little bit off on the bottom as well. So there you go, 61.8. Everything is confluence at 350 from a Fibonacci perspective. What do we have from an anchored VWAP perspective? Let's throw that on here with the QQQ. Same comment about not fully resolving this anchored VWAP from the AI Mania breakout. This pullback closed underneath in the week prior, closed on it in last week's session. If we rotate away from it, I would say a break over the top of this prior range here, right? So over last week's high, which is 372, that's the number to beat. Over 372, that VWAP has resolved in the upward direction. Breakdowns under 358, looking a bit more powerful for a rotation here. Your next one is roughly at 343, and confluence with 343 or 340 roughly is going to be your volume profile out of the QQQ. So rejecting in the upper wick of last week's bar, this high volume node. We've got the same concept where at the soft lows, there's a minor high volume node here, but falling through the low volume void brings you back to, lo and behold, 340. So 350 and then 340 are the larger downside targets from the weekly perspective. Over 372, the top of that little micro balance range in there, and we're going back to the head of the possible head and shoulders pattern here, right? That would be here, closer to 385. We'll see that on the daily time frame chart now because that's where we're headed. Let's take a look at the QQQ daily time frame chart. What do we see from an expected move perspective? So this time, the upper bound of the expected move is the high of the Thursday gap up, and once again, that number is 372. I would consider it strong resistance for all the same reasons we discussed over on the S&P. I won't walk you through every single one this time, but there you go. There's your prior resistance. It was prior overhead supply support, already turned to resistance here, daily 50 SMA, the whole 9 yards. We know that we've been in a daily downtrend for longer out of the QQQ with a lower high in place here. Lower low was produced. It's been pain ever since. This is a lower high from here to here and rejecting a key level of structure. So we could say the same comments about the Friday bar failing to materialize underneath Thursday's lows. Once again, Aerosmith comes to mind, same old song and dance, not really much to update you on there. If this is going to turn into a head and shoulders on the weekly, we know we've got to be underneath 358. That's the breakdown of your neckline there. If it is going to turn into a double bottom, the number on your QQQ daily is the recapture of 372. Let's get a little bit more granular on the hourly time frame chart just so we can walk through the numbers. Again, the same concepts apply as to what we just discussed on the S&P, but these are the numbers, right? We're neutral with a small bearish edge underneath 364.75, but over 361. Why? Because there you go. There's the failure higher, failure lower, back into range. So why did the sellers not materialize? That's the key question to ask, right? So neutral to slight bearish edge here because of the overall daily downtrend if we're in between those two levels. You can see that there's thin structure to retrace. If we get some sort of break to go higher or low above 364.75, first target would be here, the bottom of this as overhead supply from the Wednesday rally, right? There was no respect for it on the Thursday breakdown, right through it. 368.50 is the first target, and then beyond that, it's the daily neckline at 372 for the double bottom, right? If this is going to turn into an hourly head and shoulders, something that would look like this, you've got to stay in this zone, and you've got to break down under 361 to target 358 to get to your daily or weekly head and shoulders neckline, and then beyond that, that's where the nastier downdraft can resume. Daily downtrend can resume. We would not be holding a weekly higher low underneath 358 out of the QQQ. We could take a look at our VWAPs here, the anchored VWAPs for the QQQ, and it's the same concepts, right? So here's the VWAP from the low. Here's the VWAP from the breakdown on Thursday. Just like the S&P, we've recaptured both of those VWAPs after falling straight through them on the Thursday close. So the fact that the sellers are not producing a lower high there and continuing in the downward direction leads me to believe, once again, we're neutral in here with a slight sort of inclination that that is an acceptable outcome on a higher low over 364, 75, with the target being here, because over time, your high, I don't think it's not the all-time high, obviously, but yeah, it's the lower high here, sorry, from here to here, is the anchored VWAP that will start to act as confluence, 368.50 as a target, right? Let's move along and take a look at the market internals for the NASDAQ side of things. So it's the same story, right? It's the same story. A little bit more substantial outflows on the Thursday session, but Friday follows it up with a move in the upward direction. No follow through from the sellers. More of a substantial move into trend lower zone on the Thursday session. And this should not come as much of a shocker, right? NVIDIA, much more of a heavyweight representation in the QQQ versus the more diversified S&P 500, right? So there shouldn't be any surprises based on the more severe weakness on Thursday specifically out of the NASDAQ side of things. But again, look at Friday in the advanced decline line. A little bit more time spent underneath the zero line here as compared to the S&P. The S&P had a sharper recapture of the zero. That is noteworthy. The S&P also had a bit stronger of a cumulative build on the Friday session. So maybe the NASDAQ remains a little bit weaker than the S&P for those reasons that we just kind of assessed here out of our market internals specific to the NASDAQ side of things. Here's the market profile. Same old song and dance. Again, I'm not going to beat a dead horse, but this is the open from Thursday, or excuse me, this is the open from Friday, opening at or slightly at the base or top, really, of the spike from the Thursday afternoon. So sellers who are in trouble, right? We know the whole 9 yards. There we go. It's the same concepts. Overall, value is lower, though, out of the NASDAQ. Point of control is lower out of the NASDAQ. We do have a poor low and decent excess at the highs. So overall, I would, it would make me think, rather, that opening in here, it's not so much that we're looking for a break of this as a poor high, but instead, I would say if we can move into the single prints from the breakdown on Thursday, we've got some pretty clear targets. The first one would be here, around 15,185, and then beyond that, up and over 15,240, you can look for the high of Thursday, and lo and behold, that's the neckline of the double bottom on the daily time frame chart, right? So your upside targets and pit stops basically are very well defined based on the string of single prints. We don't have a poor high, but all the same concepts with the failure from the sellers on Thursday apply from a market profile perspective. IWM Russell 2000 and the small caps. This one is a bit definitively different here. You can see that we've got a red body doji as a 3-bar play potentially setting up in the downward direction here. However, location is extremely neutral in the grand scheme of things. We're in the midpoint of this as an overall range. And what do we always say about being in the midpoint? You do not diddle in the middle, as they say. You don't really have a competitive edge here from a risk-reward perspective. We're also not sitting at the retest of this level quite yet, and we're inside of this zone underneath 188, which was your key level that wanted to hold if a higher low was ideally going to be put into place. So the weekly chart of the Russell here is extremely neutral for those reasons. We could take a look at the anchored VWAP specific to the IWM, and you are sitting on the low anchored VWAP from October of last year. If this is going to act as support, you need to take out the inside bar high and recapture the all-time high anchored VWAP and the 188 level here to be more constructive as this holding for a weekly higher low, right? It's almost like so close to almost call it an equal low in the midpoint of this as an overall range, but that would be the more constructive look, right? Breaking the inside bar high, recapture the all-time high anchored VWAP, that's a bit more constructive for the upside here. Really not much to write home about from a fib perspective, so we won't even bring those up. Let's take a look at the volume profile. We're sitting on a high volume node. You really don't want to get active at a high volume node. You want to get active as you're pushing away from it. So what are the high volume nodes that could be in play? Well, the bottom of the range here if we break down, and the top of the range if we break out. So once again, your edge in the midpoint is pretty much non-existent here on the weekly time frame chart of the IWM. Let's take a look at the daily chart and see what else we can learn about the price action. Once again, Really mild week, really neutral week, not much to write home about over here. We're inside of this as a prior range. We know that we broke. We never held for the weekly high or low there at 188.25. The breakdown was fairly aggressive, so we do have a 100% retracement. You don't really want to be short in the hole, but after some sideways consolidation like this, it starts to feel much more so like a bear flag, and breaking down would be acceptable now that we've digested this move I'm referring to lower, sideways via time, and we're not just instantly continuing through prior supports over here. So bear flag is on the table. However, let's take a more nuanced look at the Friday session, shall we? Same concepts as everything else. So here's where it turns into the same old song and dance. Sweep the low, close back inside of range, look below and fail is totally on the table from an hourly perspective, from a balance perspective, right? If this is the balance range, you already got look above and fail, you already got look below and fail. Now we're in the midpoint of the range. So what's the constructive look going forward? If you're going to see a stronger counter trend rotation out of IWM and small caps, you need a higher low to cement itself over 185 on the hourly time frame chart. Then we'll look for the rally to this location at 188.25. And when we get here, you will look for a big time daily lower high, right? Why? Well, of course, it would be the rejection of this back test, right? This and this, that sets up a big time head and shoulders, and we're good to go underneath 180.75 if the broad market is going to see more of a severe breakdown in the downward direction. Obviously, first target would be, let's go back to the hourly. If we do not get this, this sort of reaction and then that over time, if we just stay inside of the balance range and we sweep the lows, I would say that you want to be watching the 200 SMA on the daily chart, roughly 183. Breaking underneath that, stronger target below would be at 180.75. Let's take a look at the market internals for the Russell side of things. It's really not all that bad. It's fairly neutral. I would say that it had the most substantial volume outflows on a relative basis for what we would consider substantial in the small cap world. So negative 100 million, it's not nothing. It's not great for downside momentum, but it's also not nothing. It's certainly not flat like what we saw out of the NASDAQ and more so the S&P. Advanced decline line, just chopping around, not really getting towards trend anything zone at any point this week, which makes sense, right? It's really confirming that this is much more so a balance on the small cap side of things instead of larger trending type activity. Same thing out of your cumulative builds in the tick, higher, lower, than neutral on the Friday session as the sellers fail underneath those lows over here. That's that big daily lower wick that we just saw as a hammer candle. So keep it simple on the IWM as a broad market indication, as sort of a bellwether gauge for the broad market. Over 185, lean on more of the bullish edge for possibly taking out some of the upper resistances in the broad market. If we stay contained within range, I would be hang tight, right? Basically looking for bearish to neutral consolidation in the broad market if IWM is under 185. Last but not least for the IWM is the market profile. And the only thing I want to write home about here is if this is the balance range, where's value on Friday? For the most part, it's in the balance range, speaking to neutrality and not so much progress made in the downward direction. If you've made it to this point in the show, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe if you've not already done so. And let's kick things off with Apple here. Certainly looking at a green hammer candle on the Friday session after a breakdown from above our prior gap down bear flag range over here, which closed underneath. So looking at this as well as sort of a failure from the sellers to materialize and the possibility, not a guarantee yet, but the possibility for some sort of daily inverted head and shoulders to unfold. Perhaps a little bit more clearly, we can see this on the hourly chart. If we can get back up and over, let's zoom in a little bit more so on this here. There we go. If we can get up and over this balance range, meaning a higher low is confirmed, not like this, just consolidation, but a higher low is confirmed over 179.75, I think we can start to retrace some of the thin structure from the earnings breakdown. 182.20 becomes a target, and then 185. If we produce a lower high and just continue to chop around in here, it's quite simple. You wait for a move outside of the balance. I would not get overly active in an area which has proven to be choppy in the past. 177 is the bottom, just as a reference. Next up is Netflix. Let's go to a daily chart here because I think we have to understand the dynamic at the neckline of the daily head and shoulders, right? Multiple failures in both directions. So sellers would have ideally produced a lower high underneath for continuation in the downward direction. When we recapture from the buyers, okay, buyers would have ideally produced a higher low above. Thursday is underneath, Friday is right on it. So 415 is the number that needs resolution. It's really too soon to say one way or another. Looking at this chart again, it's just very, very difficult to say what 415 wants to hold for us. If it does hold, meaning we're above it, and we get a breakout of like some sort of opening range or an opening drive higher that pulls back over an upward sloping VWAP early this this week, we do have thin structure on both the upside move and the downside move. I do imagine we could reattempt 427.50 sooner rather than later if there is a hold of 415. If we're underneath 415, I would wait for the breakdown underneath this level to negate this as a double bottom from in the past. That number is 406.75. The target would be 397.75 for your downside. Next up is Tesla. What's going on with Mr. Musk's used to be rocket ship? We've been calling it the boring company now that it's drilling towards the center of the earth. You'll notice it's in a balance range. So balance rules are in play. You're going to break the top, in which case you got to be a little careful on the break of the top, honestly, because 242.75 poses a big threat. Prior overhead supply can act as resistance, even if we take out this little area here closer to 240.25. So playing with caution at Tesla towards the highs here. I would say the higher confidence long is on a higher low definitively over that number. Why would I say something like that? Well, because the daily chart is already in a severe downtrend where we have highs, lower highs, lows, lower lows, and you can continue to count them in the downward direction. The ideal place for a lower high would be right here off of 242.75. So a little bit of patience required, but if the 4-day balance can resolve in the upward direction, higher lows over 242.75, target 251, 261 would be the next one. If we take out the lows, it's all about the gap close underneath 220.67 down to 217.60. Let's take a look at Google. Daily chart is still extremely useful here. Hammer off of a failure once again to get down into the earnings gap up range. They've already failed once. We made it to the top of the range. We've failed once again. We've closed inside of the range. Will we make it to the top is the key question. 133.65 is your number. Watching for a break over the top of this range at 131.50 to get there, or intraday higher low pullbacks that hold 129 on the hourly chart. You can see that as clear as day. This is your daily hammer, right? Higher low here, it's good to go back to the 131.50 and then to the top of the range, 133.65. The only time to get short on Google is if we definitively build out an hourly downtrend in the gap range to close it at 123 to the downside. It seems like a bit of a stretch with multiple failures from our sellers here. Next up, Metaverse. What's going on with Zuckerberg's Fantasyland? Equal low hammer candle from here to here. Did not close inside of the Thursday breakdown. Still an opportunity for a lower high underneath 288.75, which comes from key structure in the past. So I would be bearish on Meta for that reason. Equal low is produced. Still an opportunity for a lower high. Highs, lower highs, lower highs, lower highs, right? Next lower high is here in a picture perfect world underneath 288.75. Hourly time frame chart for a little bit more context. Again, pie in the sky double bottom, you've got a lot of work to do before you even reconsider a more substantial trend higher here. Over 301 is what it would take for that to unfold. I think that this is a higher probability outcome into the earlier stages of this week. If we do get a higher low over this, you could trade for, short-lived moves into 296. Just understand that this is not a full-blown uptrend. This is just scalping. This is scalping. Stronger uptrend is only on a higher low over 301 out of Metaverse. Let's take a look at NVIDIA. This is, it's coming back down to earth, so thanks for the gift of the gap up on the Thursday session. It was great to see it close the gap. Rejection intraday off of a lower high VWAP. I mean, all the pieces of the puzzle were really there on the Thursday session, and now we're back down inside of this as a prior range. So all things considered, you've just got some key levels to watch. I'm really interested to see how the options contracts really resolve early on in the week now that the implied volatility has gotten sucked out of them, and how people respond to NVIDIA's failure basically here at the gap up to a higher high, new all-time high, right? Over 500. So in a picture perfect world, stronger reversal happens in the downward direction for something that does this, right? This big failed gap up has to have a lot of trapped buyers involved there, right? Everybody way over optimistic, right? Buy. This thing on the gap up makes me think of Kramer and the meme, right? Now that we're underneath, any subsequent lower highs and the bulls and trapped longs start to get discouraged, it's going to add selling pressure to NVIDIA. So I'd be watching for a lower high under 470. Then obviously a flush would be underneath 254 to close or get towards the gap underneath us. Why do I keep saying 442.20 and 435.50 is the closure of that gap. Next up, we've got Softy. This one also could not really materialize on the gap up from the AI mania. It made the move higher. There was an opportunity intraday for it to hold over 326.75. No dice. No dice on the hold there, unfortunately falling back down underneath the key level. The daily chart probably illustrates this a bit more clearly, right? So that's the key level that we were just discussing on the hourly. If it was going to hold inverted head and shoulders like this, you would have wanted to see that hold for a really high right shoulder. Simply not the case underneath this as a daily level. We are in this consolidation zone, but without the hold of 326.75, I would be neutral to bearish in the grand scheme of things here, looking for lower high, equal low flush. Target would be the head of the pattern at 312.50. If we do get a higher low here, we will change our tone, and because there's thin structure, you might see 334.50 and the daily 50 SMA sooner rather than later. But it strikes me as we've been saying recently, 60-40 odds on everything in the market. 60 probably favors this type of situation here, and then 40 probably favors this type of situation here based on the posture of what we just saw from NVIDIA as well. Next up, last but certainly not least, is Amazon, the mini beast. Perfect rejection on Thursday's gap up of the, excuse me, that's not Thursday, is it? Let's take a closer look. That would have been, yes, it was on Thursday. 137. There we go. Get my days mixed up. But nonetheless, rejection of the overhead supply, right? Everything is making sense here from a technical perspective. Lower highs continue under 133.60. Equal low flush closes the gap all the way. 129.82, and that is complete from the earnings cycle in the past. Beyond that, you've got support to target at 127.75. I would only be bullish on Amazon. Now that we've definitively established a downtrend here inside of the gap range, you've got to get over 137. A lot of work to do on the bull side here of Amazon. Remember that this had the opportunity, quick comparison, right? It had the opportunity to do something similar to Google. Prior range, gap up range, right? Instead, it failed into the earnings gap instead of like Google, where you can clearly see a hold of the earnings gap, which is definitively more bullish in the upward direction. Let's take a look at a couple of additional trade ideas. First up on the chopping block is ROKU. ROKU is the ticker on that one. And you can certainly see that we are technically in an uptrend here with lows, higher lows, higher lows, higher lows, and highs, higher highs, higher highs. However, as this downdraft has unfolded, the earnings gap and go has resolved to the downside, full 100% retracement with multiple little lower highs being set here during that retracement. If we can flush underneath the open of that green bodied bar, which is at 74.90, I would look for a 3-bar play in the downward direction to target the support trendline. When we get to the support trendline, I would not overstay my welcome, noting that we do technically have an uptrend building in this segment of the chart. So it's a short-term breakdown if the broad market is weak underneath 74.90. A rough target, if it happens early on in the week, 71.25, maybe up to 71.60s a little bit later on in the week as your support trend line. That is a downside play for ROKU. Let's take a look at CRM as the next trade idea. What's going on with Salesforce over here? We've definitely got an inverted head and shoulders ahead of earnings. Please do not trade this through earnings as any type of swing with a Friday expiration. If you've got longer plans, so be it. Be my guest. However, as a short-term trader earlier on in the week, here's the hourly time frame chart. If we can get some sort of higher low over 211 roughly, I'm looking for this to retrace this thin void to back test the overhead supply at 215. Roughly a 4-point move in the upward direction. If it wants to pan out that way in the first place, again, I would want the support of the broad market moving in the upward direction for CRM and support of the broad market moving in the downward direction for ROKU. Let's take a look at Adobe. ADBE is the ticker on Adobe, and this one has the potential risk of falling if the AI mania music stops. If we move underneath this area of support, this is where a breakout happened, thin volume structure, right? Retest of this as demand underneath would bring you from let's call it 511 down to 490, right? So plenty of range to trade there in the downward direction. This is one of the last of the big boys, right? At a high price point like this, the options chain isn't great. It is a little bit spready on Adobe, so just be careful if you're trying to scalp this. Understand that you want to be buying on the right side of the spread, not the wrong side. You will get gobbled up if you are, sloppy on Adobe. So that's fair warning. All right, Adobe has a rough options chain. Let's take a look at BA. What's going on with Boeing? We've got a gap to close overhead. Same concept as the broad market. Big failure underneath Thursday's lows, closing almost at the highs of Thursday's session with a gap to close overhead. Here it is on the hourly time frame chart. You can see high and tight consolidation into the close with a little minor break towards the high of day. Over 224.17 closes the gap to 227. Plenty of range to trade as a day trade, right? So looking for a little bit of a scalp here, again, with the participation of the broad market. That's what I've got for you in today's session of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a thumbs up. I hope to see you all in the pre-market prep Monday morning sharp, 8:15 Eastern time. We'll crack some jokes and have a good time together. And with that said, I wish you a green trading week.